Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have the CEO, Chris Dobbin from Leap Health. Leap trades on the TSX Venture Exchange under the symbol NLH and on the OTC under NVLPF. The company is currently trading at 43 cents with roughly 79 million shares outstanding, or about a $34 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks a lot, Trev. Yeah, great to have Chris back. It's been a while since we've last spoken, and clearly you guys have been busy since we've last spoken. I noticed record 2021 revenues, record Q1 results. So why don't we get into that? But before we jump into that, why don't you remind everybody what Leap's all about?
Yeah, sure. I appreciate you having me back on. So our quick story is we're in a home care space. Started the company about 6 years ago, and we essentially go in and we provide non-medical home care in seniors' homes or within facilities. So think of us as private pay in home care company. We've been in that space since we started the company 6 years ago, and operations in 11 states in the US and as well as in Nova Scotia.
Fantastic. So why don't we dive into the numbers? We'll jump into 2021. Record revenue. You guys revenues grew by about 23%. What happened?
Yeah, so our history is we've been a fairly acquisitive company, right? So we buy a lot of small mom and pop shops. I think we've made to the tune probably 20 acquisitions to date, and on average, I think over the last 5 years we've closed about one per quarter. And so last year we ended up closing like 5 deals. I think 2 sort of mid-year and then 3 in December. I think actually we closed 3 in over the span of 2 weeks. And so again, we were pretty active last year, even though it was towards the tail end of the year. We've been making acquisitions since we started the business. And we expect to continue to make acquisitions. So it's been primarily driven by acquisitions, and that's how we set the record revenue last year. I'd say we sort of have to look at our business from 2 perspectives, at least how I do. One is what was happening sort of pre-COVID, and then what's happened since. And prior to the pandemic, we were really, I think, on a great trajectory. Record revenue, record EBIT on a quarterly basis. Things were really, really rocking quite well. And then we took a hit during COVID, and it impacted both our cash flow as well as the revenue. And we're building out of that on the businesses that we had prior to the pandemic, but it's been slow. And so, sort of gradual incremental improvements, and that's the way I've always looked at the business. And on top of that, we've added new businesses, which we're quite happy with. But so those are really the 2 things. One is where there's a build back on I guess the revenue as a result of cash flow lost during the pandemic, and 2, there's the addition of these businesses. Our situation is a little bit unique in terms of when I'm talking about the impact COVID's had on our revenue and our cash flow. It's true, although we benefited quite a bit from government subsidies, both in Canada and particularly in the US, several $1 million of subsidies in the US. And so it ended up in a bit of a unique situation where our revenue was down on those agencies that we had pre-pandemic, but we were making net income far greater than we'd ever made because of the government incentive programs. So it was a bit of a very unusual year last year in terms of we did very, very well from a financial perspective, even though we were really impacted by COVID.
Understood. Now, in Q1, what can you tell us about Q1? Any highlights there?
Yeah, so really that was building on the 3 acquisitions that we did in December. And we closed 3 acquisitions at tail end December. And so then they were fully baked in Q1, and so that's the result of why we had such an increase in the revenue. 3 good businesses that we're quite pleased with. We think they're going to be they'll serve us well long term. Happy to go into those markets. And so, but that's the direct correlation between the businesses we acquired in December and obviously having them fully baked in for Q1.
Mm-hmm. And looking forward, how do we look at your pipeline or any change in strategy for M&A? Is there a different geography or different type of business you want to look at, or is it more the same?
Yeah, I mean, the way that we've approached geography has been twofold. One is, in the areas where we currently operate, where we have, critical mass. And so that would be in the New England area, now in the Midwest, South Central, and then in Nova Scotia. Those are regions that we kind of look at. And we have depth in those regions. When I talk about depth, it really has to do with the fact that we've got a management structure that gives us that depth. So if I take the South Central region, where we're in Oklahoma, Arkansas, and Texas right now, I have one person's running all three of those states, multiple agencies, multiple locations, and that's really what we look to do. And so we're continuing looking at agencies within those areas, and because we already have the management team in place to run them. And the same thing for the Midwest, Nova Scotia, obviously where we are, as well as New England. The standalone area I'd say we have right now is in South Carolina. So it's a business we just acquired again in December. A great operator there, so quite pleased with that business and expect a lot of that going forward. And so we can build out in that region, but right now it's a bit of a standalone agency as opposed to some sort of regional depth that we have. So we're opportunistic if we see a good business that we want to acquire. That's been our forte over the last several years, but the preferred method is definitely to do a bolt on to an existing area where we already are.
And let's call it post-COVID now, hopefully. Are you finding it easier on the M&A front, or is it harder? Is there more variables now? Is there more issues?
Yeah, good question. So it kind of goes in waves. I mean, one is, I think we're coming out of COVID, but there's still some pockets where we do see some pressure. I don't see pressure, but numbers of people that are impacted, whether it's clients or caregivers and so on. So we still do see some of that in certain areas. From a pure M&A perspective, good question. I mean, I think what I would say is that the environment that we were in over the last couple of years was, the valuations were pretty attractive, I think, for the sellers, like probably the most attractive that I've seen since I started the business, really. For ones that were really successful, pretty consistent, that have been growing over the last, through the pandemic and so on, I think they attracted some pretty good valuations. Be interesting to see what happens over the course of the next, whether it's 6, 12 months or longer, given that we're in a bit of a different environment now, right? We have a rising interest rate environment. We have the markets obviously haven't been performing that well. And so you have lots of folks that have lost lots of money, whether it's high net worth or funds and so on. So sometimes a little bit less capital to go around. I expect that'll have an impact on some of the valuations, but that remains to be seen. So I don't think we'll ever run out of opportunities to buy businesses. It's just there's too many available. So from an opportunity perspective, the pipeline and so on, that's always been strong. It always remains strong. I think the question is, do the valuation metrics change much over the next 6 to 12 months? I don't know. We'll see.
And your balance sheet, what is it what does your ammunition look like as far as more M&A?
Yeah, we've got about, we just reported, $1.6 million of cash. Our debt's pretty interesting because we don't have a lot of debt on the balance sheet right now. And so getting back to our history, we started acquiring these businesses and using leverage at the tail end of 2017. And so our first loan actually falls off the table at the end of this year. And then the remainder of the debt, with the exception of one loan that has 7-year AM, it's all going to be gone by the end of next year. So our balance sheet is going to look actually vastly different at the end of 2023 because we won't have any bank debt as it relates to existing agencies. And so I think from that perspective, we're in pretty good shape. We generate cash flow from the agencies that we have. Then I think we'll be in a really, really good position to deploy bank leverage as we have in the past and continue to do deals.
Now, you guys you're sort of a labor-intensive business. How are you guys finding sort of the labor issues? Are you having, a hard time finding staff, or is that working for you guys?
Well, staffing's always been our yeah, it's the way that we operate the business, right? So it's always been, say, a challenge, the right word, but it's the balance between hiring good people and matching up with families, right? So if you think about our industry, we have a constant demand for services. This is the age demographic, people in their homes within facilities, particularly those living with dementia. So that demand, I don't think is ever going to go away. It's just based on demographics. That's just an increasing number year after year. And so what agencies have to do, like ours within our industry, of course, is match the right people with families. And even pre-pandemic, I think that's always been the challenge, making sure you've got the right labor pool there. It was a little bit more acute, to borrow the health term, during the pandemic. I'd say there's more applicants now, where we are seeing an increase in applicants. They may not always be the right fit, the folks that we're looking for, but it's a good sign. I think at least there's been an increase. And I think the comment around sort of the inflationary environment, and I put this out in the press release, is that, if you think about, an inflationary environment where we are, and that could have an impact on caregiver wages, we are in a private pay space. We're not impacted by, Medicare, Medicaid. It's really an out-of-pocket service. Some Veteran Affairs and long-term care insurance, but primarily out-of-pocket, either by those we provide the service to or their adult children. And so, we do have the ability to keep our margins pretty consistent, and that has been the history of our company. Quarter after quarter has been consistency within the gross margins. It doesn't deviate a whole lot. So I think we've done well through the inflationary environment.
So, I think you just answered a question that came in. So you guys are able to pass through some of that pricing or sort of inflation pricing to your customers.
We can. If you take a look at our Q1 results, I think our gross margin was 34.8%. So pretty near the top end of where we've been. Maybe not I think we might have had one other quarter where we had 35. So again, normally in an inflationary environment, you may see the gross margins come down. Ours have ticked up slightly, but again, within historical ranges. So no big deviation there. So that's why when we talk through inflation, for us, I think of inflation primarily as a labor pool. It's not like we have a whole bunch of office expenses or travel expenses and so on. And so, we're pretty lean from that perspective. So I think the private pay does give us, the pricing power gives us an advantage over folks that may not have the ability to adjust prices where necessary. We can do that.
Right. I want to remind everybody, if you've got a question you'd like me to ask Chris, please use the chat function. I'll do my best to ask the question. Okay, so labor is kind of always a challenge. What other challenges do you guys face right now?
That's really the biggest one. That's sort of the biggest restrictor to growth we'd want to achieve, right? That's the biggest one. I'd say that's really the biggest challenge that we focus a lot of our time and efforts on, is how do we attract good quality candidates? How do we keep that funnel going? Are we doing a good enough job of keeping our current caregivers, right? There's two aspects of this. There's one, those we hire, we want to keep. And it's interesting. We've got some success stories where we've got folks been with the agencies we've acquired for 15 years. And, to me, that's fantastic. We get that every day than we would, right? So, what are we doing to treat people well, matching them up with the right manager, providing them good feedback, giving them training, particularly around dementia, and paying them well. Those are the things I think they look for. There's usually 5 or 6 things that always show up on the surveys. And so I think if we do those well, and that keeps the turnover lower, and then it's a matter of keeping, attracting other good candidates to the pool. So that's kind of the approach we take. So we're always trying different things. It's always a work in progress.
No doubt. How big is the pool of people? Like how many staff do you have?
Geez, I think we're up around 850, 900 now.
Okay, wow.
Yeah, across the 2 countries. Yeah. We're roughly in around there.
Yeah, gotcha. And like sort of geographic split, how much, I know the majority is in the US, but sort of what kind of percentage of your revenue is generated in the States?
Geez, what are we, 80-20 now, I think, roughly.
Okay.
I think the number will increase over time in the US. That's where we spent a lot of the investment, and that's where we see a lot of the opportunity, but you know, it varies obviously every quarter slightly, but you know, that's kind of the way I think with the business.
And like, okay, so you've been a public company now for a fair while. It's like a lot of other microcaps. It's sort of hard to get out and communicate to the masses. But is there any sort of is there anything the market's getting wrong about your business that you want to sort of clarify and make sure they understand?
Well, I don't know, because it's hard to know sometimes what the market is.
That's true. Yeah.
You know, it's funny because, you know, one of the ways I've tried to really manage the business is somewhat like a private company in the public markets, right? Really, I mean, you know, stock prices go up and down, and they've ranged for us, I think, is, you know, 52-week high, I think, was 99 cents, and our low, I think, was recently at 30 some. And the business hasn't changed, right? Like, it really hasn't. And I think we're fortunate, and I don't know that all nano caps could say this, but you know, we could keep running this business like we are, keep growing, picking away, you know, tiny little companies for the next 30 years. And I think without ever having to raise capital. And so I think we've been fortunate that we put ourselves in a position that, you know, we can act when we want to act and at the right moment. And if we don't want to act because of the circumstances as they are, then we don't have to. Like I said, I think the debt, sometimes people look at the demand loans that show up in a balance sheet and say, well, geez, they have a lot of debt. You know, demand loan means they're current, they're due now, but of course that's not the way it works. And so I think sometimes the people that take a little bit of a harder look at our company and get into the details, you know, get a slightly better picture. And then I kind of let our insider buying speak for itself, right? I mean, we just had some more recent insider buying. One of our directors was buying in the market. I mean, I bought a little bit recently, but you know, however people want to perceive that, then they'll perceive that. But I think to me, that's always been a good indication. I mean, I've always liked it, and I think it shows the market that you know, the folks around the table are serious about the company. You know, we've always led investment rounds in the past. We've always participated. And so, you know, again, you know, when I look at investments, I always look at it from the same perspective as I think someone would look at ours, you know. Who's put money in? How are they set up financially? What's the opportunity? And that's why I like our company. So, you know, I'll let people do the research and they'll evaluate the company as they see fit. But, you know, I think we're in a good spot.
Yeah. No, clearly you guys have been, you've put your money where your mouth is. I think I've always respected that since I first got to know you guys. And the other thing you said is certainly it's something we talked for a bit about in the markets right now is you want to own businesses that are self-funding, right? They don't need to go back to the market. They're real businesses and they're generating, you know, sort of their own cash. So good on you for that. I got a question here. It just says, at what price NCIB versus acquisition? So do you guys ever consider an NCIB as opposed, well, to use some of your capital?
No, I mean, have I ever considered it in terms of a thought? I mean, sure, because it's one of the pillars of allocation of capital, but I'd say for us, I mean, it would be nowhere near the top. And that's because if I think about allocation of capital in that context, I would put money towards paying down debt before NCIBs. Right. Just for us, it wouldn't make any sense whatsoever.
Yeah, no, fair enough. Well, listen, I think we've sort of covered most of it. Is there any other thing that you want to sort of mention, any key takeaway or, you know, last sort of parting thought that you want everybody to have as we go?
Look, I've always looked at our opportunity as a long-term opportunity. And you know, maybe I didn't think the stock price was ever going to be as low as it is again, but it is where it is. And so, you know, look, we're going to be doing this for the next couple of decades from my perspective. And so, you know, people have an opportunity to participate if they want. And I like where we are. I like the team that we've built. I like the insider ownership. I like what I see in the market in terms of opportunities. I just like the way we position the company. So we're still small. I mean, and so because we're small and a lot of people say that we're boring, to me, I'm pretty excited about where we're going. So I don't take any offense to people calling us a boring company, anything like that. I think we've got a long runway to do what we've been doing, and I just really appreciate the opportunity that folks have taken an interest in the company, and certainly appreciate the time that people spend to at least consider us from an investment perspective.
Yeah. No, I appreciate it, Chris. And listen, I mean, with the kind of volatility we've seen in the markets recently, boring is not necessarily a bad thing. So I love boring businesses that generate cash. So keep that coming. Okay, one last question is before we go. I guess is an easy one. What percentage of the company are owned by insiders?
36%.
There you go. Good, healthy 36%. Well, perfect. Well, listen, everybody, we've been speaking with Chris Dobbin, CEO of Nova Leap Health, symbols NLH on the Venture Exchange. Chris, as always, thanks for joining us, and I look forward to catching up in the near future.
Thanks for having me. I really appreciate it.
Awesome. Thanks a lot.
All right. Take care, guys.